Okay, so this time, asset pricing, no? Asset pricing is a fundamental concept in finance, no, that deals with determining the fair value or price of financial assets, no? Katulad po ng stocks, bonds, at saka yung derivatives na tinatawag. So, it is a critical aspect of investing decision making as it helps investor assess whether an asset is overvalued, undervalued, or fairly priced, no? So the fair price of an asset is usually influenced by factors katulad po ng risk, uh, return, time horizons, and the broader market environment. So understanding asset pricing is essential for both individual investors and institutions in optimizing their portfolios and maximizing returns. Now, one of the core concept in asset pricing is the trade-off between risk and return. No? In general kasi, investors expect to be compensated for taking on additional risk through higher returns. Assets that carry more risk, such as stocks, tend to offer higher potential returns, while lower risk assets such as government bonds provide lower returns. So the challenge for investors is determining how much risk they are willing to take and how much return they expect in exchange. And this balance forms, no, the basis of most asset pricing models. And to give us more details about the topic, let us all welcome our presenter. Go ahead.
Okay po. Thank you, Dr. Marmelo, for that introduction of my topic. So my topic for this afternoon is about asset pricing models. So again, once again, good afternoon, Doc and colleagues. So for the intended learning outcomes, our objectives for this topic is to theoretically understand and critically evaluate various asset pricing models. To apply these models to estimate the value of financial assets and portfolios, use asset pricing models for risk management, performance evaluation, and investment decision making. So, and then we have to recognize the assumptions and limitations of these models, particularly in real-world contexts. So, let's start with the topic. First, let's understand what is asset pricing models. So asset pricing models is an essential tools in investment analysis and portfolio management. It helps investors understand the relationship between risk and return, estimate the fair value of assets, and construct portfolios that optimize performance based on risk preferences. So it guides decision-making in asset allocation, risk assessment, and performance evaluation and hedging strategies. So as per the previous topic, nabanggit nga po na in portfolio management, we are evaluating risk in investing. So here in asset pricing models, these are the models that can help us identify more and assess the investment properly and comprehensively for us to manage and understand more of the risk in the investments. So in portfolio management, a key input in portfolio construction is the expected return for an asset. In corporate financial management, computing a firm's cost of capital requires that the cost of equity be computed. So in every investment, of course, we are always aiming for the expected return of an asset. So let's start with the different asset pricing models. So the first one would be the capital asset pricing model. So the CAPM is one of the most basic and widely used models because it calculates the expected return of an asset based on its risk in relation to the market as a whole. So this is the basic as the CAPM as the basic would be the return of the investment risk in relation to the market. So here's the computation or the formula for the CAPM. which is the E or RI is the expected return of the asset, and the R over RF is the risk-free rate, and the beta is the asset sensitivity to market returns. The E times RM is the expected return of the market. So the key concept of CAPM suggests that the expected return on an asset is determined by its sensitivity to the market risk or bet or what we call beta. The higher the beta means the higher the risk, which should be compensated with higher expected returns. So yun nga, as we have mentioned, the higher the investment, the higher the risk, and which we can expect a higher expected returns. So the implications of this CAPM in investment analysis and portfolio management. So in investment analysis, CAPM is widely used to determine the expected return of an individual, asset, or portfolio based on its risk, as measured by beta, which shows how sensitive an asset's return is to the movements in the overall market. So the investors can use CAPM to evaluate whether a security is overvalued or undervalued by comparing its expected return to its actual return. So in portfolio management, for an example here in the investment analysis implications, we can say that if a stock expected return based on CAPM is 8%, but its current price implies a 6% return, the stock might be overvalued and a poor investment choice because bumaba yung expected return ng isang investment. So, in portfolio management naman, CAPM helps portfolio managers assess the risk of adding new assets to a portfolio. The beta coefficient of individual stocks or asset classes can help determine how much market risk or systematic risk a portfolio is exposed to. So it is used to construct efficient portfolios by combining assets with low or negative correlations to minimize the risk. So for example, a portfolio with beta of 1 is expected to move in line with the market. So a portfolio manager might reduce the exposure to high beta assets if they expect increased market volatility. So the next asset pricing model will be the FAMA French 3-factor and 5-factor models. So this model expands the CAPM by introducing two additional factors, which is size and value. So here in this model, there are two additional factors from the CAPM model. So the SMB, so here's the formula, the SMB will be the small minus big returns of small cap stocks minus large cap stocks. And the HML, which is the high minus low, returns of high book to market stocks minus low book to market stocks. The key concepts of this model is that the size and the value is the drivers of assets returns in addition to the market's risk. So that is the additional from the CAPM, which is, I think, more comprehensive for us to evaluate the investment. So its implications for investment analysis is that these factors provide a better explanations for stock returns than CAPM alone because of the additional factors like the value and the size. So the investors can screen for value stocks, small cap stocks, or highly profitable companies that have historically outperformed. So, in portfolio management naman, um, this model can be used to build factor-based investment strategies by tilting portfolios towards factors like size and value and profitability. Managers can enhance returns and manage risk associated with different market conditions. So, here, portfolios are constructed to emphasize factors like small cap value, high profitability stocks, and based on historical outperformance of these factors. So, for example, a stock with a strong value factor or high book to market ratio might be favored by a value investor using the FAMA French model. So, by having having the history to be the preferences, so it can be favored by the by the investor using this model. So pwedeng gamitin yung history ng movements of the stocks para magbigay ng decision for the investor. So yan. So the next model will be the arbitrage pricing theory. So the APT is a more general alternative to CAPM. Instead of focusing solely on market risk like CAPM, APT allows multiple factors to influence asset prices. So here's the formula. So the F would be the various factors that influence asset prices. So the beta would be the sensitivities of the assets to these factors. So here in this theory, um, it doesn't specify what factors should be included, but assumes that asset returns are influenced by a variety of systematic risks, such as inflation, interest rates, or etc. So in this model, we are now considering the different factors or risks that might affect the investment. So its implications to investment analysis, it offers a flexible multi-factor model for analyzing asset returns. It allows investors to account for various macroeconomic factors that influence asset prices such as inflation, interest rates, and GDP growth. So it helps investors assess whether an asset is correctly priced given the multiple risk factors that is exposed to. So, mas matutulungan nito yung mga investors to consider multiple various external factors that may affect their investments. So, in portfolio management naman, so portfolio managers use APT to build portfolios that are exposed to specific macroeconomic risk or factors while minimizing exposure to undesirable risk. So APT allows for a greater flexibility than CAPM by including multiple sources of risk. So managers can diversify their portfolios by selecting assets that have different sensitivities to various macroeconomic factors. So here, tingin ko pa mas protected yung investment pag ito yung ginamit na model. So, for an example, for our arbitrage pricing theory, so if an investor expects inflation to rise, they might adjust their portfolio to include assets that are less sensitive to inflation risk. So, ayun. So, bali, parang nagiging ready sila or parang mas na nakikita na nila yung future or parang na-predict nila yung magiging future ng investments using this model. So next would be the consumption-based asset pricing model. So the CCAPM links asset prices to consumption preferences and decisions by investors. So this will be the formula where M is the marginal utility of consumption. So the key concept for this model is that the investor seeks to maximize their consumption over time, and risky assets are priced based on how their returns cover with changes in consumption. So dito naman, ang pinapredict naman nito is yung consumption or gusto kasi ng mga some investors, ang gusto kasi nila is ma-maximize nila yung assets nila over time. So these models can be used to compute for the returns cover and changes in the consumption over time. So the implications would be in investment analysis, the CCAPM relates assets prices to changes in consumption pattern. It helps long-term investors analyze how assets returns are related to consumption growth, especially in periods of economic uncertainty. So investors can assess whether an assets provide an adequate risk premium for the uncertainty in future consumption. So some investors want to realize gusto na nila agad malaman kung in the future magkakaroon ba ng inflation, or of course they want to predict future uncertainties like yun nga, inflation. So tinitingnan nila kung yung investment ba nila is magiging mas worthy ba sa future kung ipapagpatuloy nila yung investment nila, or mas okay ba na i-withdraw nila ngayon para mas mapakinabangan nila yung asset nila. So in portfolio management naman, portfolio managers focus on long-term goals such as retirement portfolios can use the CCAPM to structure portfolios that match consumption needs over time. It helps in aligning investment strategies with consumption and income goals. So long-term portfolios can be titled towards assets that are less sensitive to economic cycles and consumption shocks. So based on these models, this can be used for the investor's long-term goals such as yun nga, yung retirement portfolios. So na-assess nila agad kung makakatulong ba ito sa mga long-term goals nila. So for example, if a consumption is expected to fall during a recession, CCAPM might suggest that higher assets like stocks will require higher returns to compensate for this uncertainty. So in portfolio management naman, a portfolio manager might increase the allocation to safe assets such as bonds during periods of expected consumption decline. So yun, nape-predict nila if may mga expected uncertainties. So i-distribute nila sa mas safer bonds yung investments nila. So yun. So in summary po, bakit
Nag-automatic po, Miss Cristel. Back nyo na lang po.
Oo nga, sabi ko bakit tapos agad, meron pa. Thank you. So next na tayo is, ano ba yun? So number 5, the fifth model will be the Black-Scholes option pricing model. So while not strictly an asset pricing model for stocks or bonds, the Black-Scholes model is widely used for pricing options. It calculates the theoretical price of options based on factors as volatility, time to expiration, and the strike price. So the formula would be this. So where D1 is this formula and D2 would be this formula. So the key concept for this model will be the price of an option depends on the underlying asset's price, volatility, and the risk-free interest rate and the time to expiration. So in this model, we are considering the price of the investment. So implications to investment analysis, the Black-Scholes model used to price options and evaluate the potential profitability of option strategies. It helps investors determine whether options are overpriced or underpriced based on market volatility and time to expiration. So investors can use Black-Scholes to guide decisions on buying or selling call or put options. So for an example, if an option market price is significantly different from Black-Scholes value, it might represent an opportunity for arbitrage. So this model can be used to know the price of an investment. So in portfolio management, so the managers use this model to hedge risk and manage portfolios. That includes derivatives. So it provides a framework for pricing options on underlying assets and in building strategies such as protective puts or covered calls. So options are used to reduce risk or enhance returns in portfolio management by hedging against downside risk or leveraging upside potential. So yun. So pwede nilang malaman yung mga risk included sa derivatives ng isang investment and pwede nilang maprotektahan to by using this model. So the next model would be dividend discount model. So this model is used to value stocks based on their expected dividends. So this is the formula where the P is for the price of the stock. D1 is the expected dividend next year. So R is the required rate of returns and the G is the growth rate of dividends. So the key concept of this model is the value of the stock is the present value of all the expected future dividends. So in this model, ina-assume nila na yung current value of stock, yun yung price nun is yung dividends for the future. So its implications in investment analysis is to use the value stocks based on their expected future dividend payments. So investors use this model to estimate the intrinsic value of dividend-paying stocks and assess whether they are overvalued or undervalued. So investors who prioritize income generation can use DDM to select stocks with sustainable dividend growth, and strong cash flow. So in this model, ginagamit to assume the dividends of the investment over time. So for example, a stock with a growing dividend and a low price based on DDM may be seen as an attractive long-term investment for income-seeking investors. So based on the example, using this model, nag-base yung investor sa growing dividend and low price ng stocks. So ayun yung naka-attract sa kanya kasi for the investor, it is a long-term investment for an income-seeking investors. So in portfolio management naman, this is used for the manager to apply and construct income-focused portfolios that prioritize dividend-paying stocks. So this is particularly useful for managing portfolios designed for retirees and other income-dependent investors. So these portfolios are designed to emphasize high dividend yield stocks or companies with a history of dividend growth. So in this model, perfecto for the investors which sila talaga yung mga income focus. So nag-i-invest sila para sa makukuha nilang income over time or yun yung mga dividend ng stocks na ini-invest nila. So next model would be the behavioral asset pricing models. So these models incorporate psychological factors and cognitive biases of investors that deviating from assumption of fully rational behavior in classical models. So they account for investor sentiment, overreaction, underreaction, and over behavioral patterns. So this model naman yung bahala para sa mga psychological factors of an investor. So this may be a strong biases for an investor in investing stocks. So para itong parang mga for impulsive buyers ng mga stocks. So ina-assess ito ng model na ito. So its implications for investment analysis is that these models take into account investor psychology such as cognitive biases or overconfidence, herd behavior, and market sentiment which can affect asset prices. So investors can use behavioral models to identify mispricing caused by irrational behavior. So these behavioral models can help investors exploit market inefficiencies by identifying assets that are undervalued or overvalued due to sentiment-driven mispricing. So yun. So for example, if an investor are overly pessimistic about a stock's prospects, it may be undervalued. So presenting a buying opportunity. So in this example, sabi niya kung yung investor daw ay nagpo-process ng ng negativity over a stocks. So a stock may be undervalued based on his or her psychological factor. So makaka-affect daw yun sa buying decision ng investor. So in portfolio management, so the behavioral asset pricing model allow portfolio managers to adjust their strategy based on market sentiment and irrational behaviors. So they can also help mitigate the effects of behavioral biases in decision making. So managers may adjust asset allocations to protect portfolios from herd behavior or market bubbles driven by irrational exuberance. So for an example here, so a manager might reduce exposure to overheated tech stocks if they believe that investors are irrationally overvaluating the sector. So this model will help protecting the investment or the protecting investors from making wrong decisions or making wrong decisions over the investments if they are seeing such psychological factors. So yeah. So in summary, the differences for the different models will be this. So the different models focuses on different purposes for different kind of investors and different purposes that of the investors investments. So in investment analysis, asset pricing models help investors determine the fair value of assets, assess expected returns and understand the risk associated with different assets. So in portfolio management, these models are used to build diversified portfolios that balance risk and return. So optimize asset allocation and manage exposures to various risk factors. So in a nutshell, in summary, these models helps the investors in decision making with their investments. So that's all for my report. Thank you very much, dear colleagues, for your attention.
Okay, so thank you so much for your comprehensive discussions of the assigned topic. No, again, as I mentioned earlier, no, and as our presenter, of course, mentioned and discussed, uh, no. So our presenter mentioned earlier, no, about the capital asset pricing model, no, or yung CAPM, no. Capital asset pricing model is one of the most widely used frameworks in asset pricing. So CAPM suggests that the expected return on an asset is directly related to its systematic risk, no, which is measured by its beta coefficient. No, beta represents how much an asset price moves in relation to the overall market. So according to CAPM, the expected return of an asset equals the risk-free rate, katulad po ng government bond yield, no, plus the beta of the asset times, no, the equity market premium. So the return expected from the market over the risk-free rate. So this model provides a simple way to assess the relationship between risk and expected return. Another influential model in asset pricing is arbitrage pricing theory, yung APT. Ano po? So unlike CAPM, which focuses on single market factor or market risk, APT po or arbitrage pricing theory takes into account multiple factors that might affect an asset's price. No? And these factors, no, could include interest rates, no, inflation, or specific industry risk. No, I believe by considering a variety of factors, no, APT allows for more flexibility in determining the fair price of an asset. However, it also requires more data, no, and assumptions, making it a more complex model to apply. Meron din tayong efficient market hypothesis, no, yung EMH. Effective market hypothesis is another important theory in asset pricing, no? So EMH suggests that financial markets are efficient, meaning that asset prices fully reflect, no, all available information. In an efficient market, it would be impossible to consistently achieve returns that exceed average market returns because prices always incorporate and reflect relevant data. This theory is often debated, no, as there are instances where markets seem to deviate from this assumption, leading to bubbles or crashes. So in addition to traditional financial theories, meron tayo tinatawag na behavioral finance, no, or finance, no. Behavioral finance has influenced asset pricing by highlighting how psychological factors affect investors' decision making. Tama naman po, no? Because behavioral finance challenges the idea of fully rational investor, showing how emotions and cognitive biases can lead to mispricing of asset. Let's say, for example, no, during times of extreme optimism or fear, prices, no, fear or asset prices might become inflated or depressed, no? So deviating from their true value. So understanding these patterns can provide additional insights into asset pricing. Wala naman tayo magagawa, no? Right now, technological advancement have also revolutionized asset pricing, no? Meron tayong tinatawag na algorithmic trading, no? High frequency trading, meron tayong advanced financial modeling tools. It had made it possible to price asset more quickly and accurately. This innovation have increased market efficiency but have also introduced new complexities. Alam naman po natin yan, such as the role of artificial intelligence is predicting asset prices. No, technology has made sophisticated pricing models more accessible even for retail investors and has enhanced liquidity and transparency in markets. So, in short, asset pricing is a dynamic and evolving field that blends traditional financial theory with modern innovation. So whether using say APM, APT, or other pricing models, the goal remains the same. Ano yon? To estimate the fair value of an asset in a way that accurately reflects its risk and return profile. So understanding the various factors that influence asset prices is critical and important for making informed investment decisions and achieving, of course, our financial success. Okay? So, yun po.